The Federal Reserve, how America gave away its money power. Most Americans think the Federal Reserve is a federal agency. It's not. It sounds official. It operates out of Washington. It controls the US dollar. But legally, structurally, and functionally, it is not part of the federal government. And that single misunderstanding has cost Americans far more than they realize. Before 1913, Congress held the power to issue money. Currency came directly from the U.S. Treasury. No permanent interest, no private intermediaries, no central banking authority standing between the people and their money. Then came a series of financial panics, and with them, an opportunity. In 1910, a small group of elite bankers met in secret on Jekyll Island, Georgia. They traveled under aliases. The press was excluded. The public was never informed. Those present represented some of the most powerful financial interests of the era. J.P. Morgan interests, Rockefeller-linked banking groups, Kuhn, Loeb and Company, international banking families like the Warburgs, and key political figures tied to Senator Nelson Aldrich. 6 men, one private island, one plan. They weren't debating policy. They were designing a system. The idea was simple. Create a central bank that appeared public, but operated with private ownership and was protected by government authority. Money would no longer be issued outright. It would be loaned into existence, with interest. The Federal Reserve Act passed Congress on December 23, 1913. That date matters. Most lawmakers had already left Washington for Christmas. Public attention was elsewhere. Quorum was thin. President Woodrow Wilson signed it into law the same day. Years later, Wilson would express regret over what had been created. By then, it was permanent. So what is the Federal Reserve, really? It's a central banking system with a government-appointed board of governors, 12 regional Federal Reserve banks, and private member banks as shareholders. Those member banks receive stock and guaranteed dividends. The American people receive inflation. Every dollar created by the Federal Reserve enters circulation as debt. The government borrows money that did not exist before the loan and pays interest on it to use its own currency. That debt never disappears, and the interest never stops. Banks and financial institutions get first access to newly created money. Assets inflate before wages rise. Savers lose purchasing power. Workers fall behind. This isn't accidental. It's how the system is designed. Since 1913, the Federal Reserve System has generated trillions of dollars in interest. Officially, most annual profits are sent back to the U.S. Treasury. But the real cost isn't what the Fed keeps. It's what the system demands. Permanent debt, permanent interest payments, and a monetary monopoly no private citizen could ever own. If a private corporation operated this way, creating money from nothing, charging interest on it, operating without real competition, and shielded from meaningful transparency, it would trigger antitrust investigations, racketeering allegations, fraud and conflict of interest inquiries. But the Federal Reserve is exempt because it's considered necessary, because it's considered untouchable, and because questioning it is quietly discouraged. Here's the moral conflict. Americans work harder each year for money worth less each year. Inflation functions like a tax no one voted for. Debt binds future generations to obligations they never approved. Control has been separated from consent. A nation founded on representation now operates under a monetary system most citizens never knowingly agreed to. The Federal Reserve did not emerge from public demand. It emerged from private necessity. Stability for banks has meant permanent debt for citizens. Understanding that doesn't make you radical. It doesn't make you extreme. It makes you informed. And informed people ask better questions.